Glad to be here. The weather's good where I am. I don't know where it is with you. If you've been traveling, it's been bad. So welcome to summer. Flight delays. Fly in the morning, not in the afternoon. So great to be with everybody. So our theme, this kind of goes back to, we have to give a tip of the hat to the California and West Coast districts. A couple of 3 years ago, we did one using the retro old station wagons when we travel as kids, and we would always ask mom and dad every 10 minutes, are we there yet? Are we there yet? And they just wanted to beat us to death because we were never there. So we thought this would be a good one. We had so many issues on the table. This is going to be an incredible week in terms of, we get the bank stress test, we get the Supreme Court ruling. They have 10 cases that they have to rule on by Friday before they go on recess on everything from forgiveness of the student loan program by President Biden to all kinds of issues. So we thought the abortion stuff was hot last June. Wait till you see these 10 cases. So it's going to be a hot summer. So we'll jump into it. Here's my disclaimer slide just for the Institute and Eugenia, that these are all my crazy ideas. So I still have about $100 on my debit card with my three special needs kids. So I'll be glad to swipe on the square the $100 if I say anything inappropriate. So I'll try not to. All right, so here we are. Are we there yet? All these issues. Are we done with inflation? I mean, the Fed didn't raise rates in June. How about fiscal policy? We got past the debt ceiling crisis. Does that mean we can go back to spending $31 trillion a year? And with higher interest rates, we now have a $500 billion more in interest. So they forgot to put that into the equation, that another $500 billion in interest. Consumer confidence, it's starting to strain. Our personal debt with the new household debt report showed we just broke a record $17 trillion, $1 trillion on credit card debt. Commercial real estate value, is it all done? Are we okay? We just devalued all the office buildings and everything else is okay. Bank failures, we had 3 big ones, we're done, right? Tomorrow we get the bank stress test, so we might challenge that. So it really is an appropriate question, or are we there yet? So some of you have seen this one that I presented to, or maybe back in Boston, I introduced it, that I feel we have a crayonomics economy. And so, my hypothesis, I've been at Federal Reserve open market meetings and whatnot, 2005 to 10. And so I know how the minutes go. And my hypothesis is that what they're doing today is they give each voting member a colored crayon, and they say, okay, go draw on the color crayon you have what's going on in the country. So inflation, red crayon. You can see it's just scribbled everywhere. Nobody knows where inflation is, or it's everywhere. Interest rate hikes and bank failures. So you see the blue is mostly on the West Coast, all those, the Silicon Valley bank failure. But nobody grabbed a green crayon, the CRE capital. And that's because generally the Fed and the bank examiners don't understand commercial real estate. In fact, when they use the term commercial real estate, it includes residential. Someone forgot to tell them that residential was not commercial real estate. But anyway, so this is kind of the thing we've got. The FOMC and the Fed are always behind the curve on commercial real estate. They wait till we have a blow up problem. So same thing's going to happen here. And it is, what I've been saying is, we all learned early in our careers that real estate was location, location, location. But what I've learned over my 38 years is it's really location, timing, and capital. And timing is very challenging right now, and capital has almost disappeared. It went out like a hole in the ozone layer. All the capital has gone out the roof. So we'll talk about those. So I do have a new term for the Fed's new monetary policy since they decided to skip an interest rate in June, and I call it jump rope monetary policy. So let's go back to March 2021 to March 2022. The Fed was kind of running around like it had a bag over its head trying to find the inflation ball. Where is it? Where is it? They said, well, it's transitory. It's over here. No, it's transitory longer. Forget we ever said transitory. So I really thought this image was a good one of where the Fed was in 2021 and 2022 on inflation. They really had no clue. And then we get to the summer of 2022. So March 22 was the first interest rate increase. They threw a quarter point out, and they went on spring break for April. And they came back in May and said, well, we got to get more serious. We got to do 50 basis points. And then they said, it's hot out there in the summer. Inflation's hot. So it was just jump, just like they're jumping the hurdles in a track meet. And now we get to the point after they do all this jumping, they do a skip. But what do they tell us in the press conference? Chairman Powell says, you know what, we're going to skip here, but we're probably coming back and we're doing more hikes. Probably do more hikes in July. We'll do more. We take August off. We'll come back in September. Well, what kind of confusing message is that to the market or any of us that need to borrow capital or access capital? This is just total chaos. And then I don't know if any of you noticed, but over the last 9 to 10 days, including Chairman Powell, who did his annual mid-year Humphrey Hawkins testimony to Congress and the Senate, that we had 9 voting FOMC members or presidents, including the chairman, go out and deliver speeches. And they all said something totally different. So if we wonder why the market is confused, this is partly why the Fed needs to have one script. They need to stick to it. The other thing I thought I'd point out, being a kind of latent student to history, I hated it when I was in school. I love it today. But I went back, in the Paul Volcker era, when Volcker was trying to get to his target for inflation, it wasn't 2%, it was 4%. So he was trying to get to a 4% level. So here you can see on this slide 6 from the St. Louis Reserve's Fed system, you can see both the CPI and the red line in the Fed funds overnight borrowing rate on the blue line. And you can see how they crisscrossed a lot. And that you look at the bottom there, it never really got until after 1987, really below 5%, but they were comfortable leaving the target in that 4 to 5% range, and not waiting until it was this magic 2% number to basically decide that they were going to cut and be done. So I think the Fed needs to go back and study. Paul Volcker's still alive. They could go chat with him a little bit about this logic, but under Volcker, the target was 4%, not 2%. And if you think about it, can our economy function pretty well at a 3 or 4% target inflation? The answer is it actually would perform better. Retirees would get a better yield on their investments and returns. Households can figure out in their basket of goods how they adjust. They might eat less steak, maybe only on the weekends rather than during the week, and substitute some item in the grocery budget, or, turn the thermostat down if the electricity costs are too high. Instead of buying an $800,000 house, you might buy a $500,000. That's what consumers do. They adjust their basket of goods. And history has told us that in that 3 to 4 to 5% range, consumers can function with that level of inflation and everybody do pretty well. So I think the Fed needs to go back and study something. So let's go on slide 7 here, inflation, because it is our big concern. Has it been tamed? Why did the Fed pause here in June? Why didn't they do it in May when CPI and PPI and personal consumption expenditures all were down? You had a banking crisis that was still in front of everybody. Why didn't they take the opportunity to pause in May instead of June? Why did they raise in May and then pause now in June? We'll get a personal consumer expenditures report here tomorrow or Thursday, and I think it's going to run hot again. But you all heard that the latest CPI that came out for May and June was, it basically said the all items was, inflation was down. It was down to an all items of just 4%. And so one of the things I encourage all of us to do right now is we need to go below data points. We need to see what's behind there to really see if there's barbecue sauce. That's my code for, being polite in the South. How do you call BS on something? It's the red shoe economics barbecue sauce. And that's what I've learned after 35 years in the South. So you see the chart here. This is already an interactive pre-made chart on the CPI data when it's released. You have to go down a few screens, go to the charts and go to the interactive by subcategories. So you see the red line, all items that I've got graphed there, but then you can click on each one of these. You can toggle them on and off, and you can look and say what electricity or food or shelter or wages are. And so you'll see there on my item number 3, 11 of the 16 subcategories had year-over-year inflation rates over the 4% that they were reporting, over 4.7, many of them in the 6 to 8% plus range. So many of us, we don't have to be, math majors to figure out that if you have 11 of 16 above your average, something strange has to be going on. And what's going on is those 5 categories, like shelter, that the Fed's playing games with, or the government are, they're changing the weightings. So in the 2008 to 2011 timeframe, we had housing weighted at 40%. And when the Fed was worried about deflation, they lowered the weighting of shelter from 40% to 25%. And that made it look like deflation went away and assets were going up. They just changed the weighting. The same thing's happening right now. They're making the overall rating of 4% look good because those 5 categories that didn't go up above, 4.7%, 4%, they're weighting them down. So look at those. Look at food. Food's running almost 7%, shelter 8%, services 6.6, electricity almost 6%. Everybody's got their first air conditioning bill. Wages going to show you this one, this next slide. We're running 12%. Anybody that's changing a job is on average getting a 12% wage. So when you have 11 of 16 items running 6 to 8%, until these, what I call super core items, the wages, the food, the shelter, the services get back below 5%, we have not solved inflation at all. And so here's the wages piece. I love good private industry data. So ADP, largest payroll processor, they really know what's happening when people change jobs and what their wages are. And what they told us in the June report for May was that people that are staying in place, they're getting over 6% wages increases. And those that are changing are getting over 12%. So if the Fed thinks they've solved inflation or done anything in the major categories, they really haven't. And so we got to go below these macro numbers. And when you see jobs reports like the BLS, 339, ADP, almost 260,000. So we're producing a lot of jobs, labor's in short supply, because those over 60 have decided to take their Social Security, downsize, go to where it's affordable. And the millennials have said, I'm never going back to retail hospitality. I have 2 millennial daughters, and they both told me that they're never going back to the work environment. So they're each doing something different, or working remote or in a call center, or one of them is tending bar and making almost $80,000 a year as a bartender in a college town, working three days a week, maybe 4 nights or part of a 4th night. So we have this barbell effect at the low end, the youth, and the older end that have left the workforce. And that's why we have so many job openings. So wages aren't going down. And that's the stickiest, hardest type of inflation to get rid of. Once you give somebody a raise or you hire them at a number, you can't come back to them in 30 days and say, I need to take 10% of that back. It just doesn't work that way. All right, consumer confidence is what we need to pay a lot of attention to. So the University of Michigan is the oldest, longest one that I look at. It's better than the Conference Board. It doesn't have as much monkey business going on in it. Very solid, proven, tried and tested methodology over decades. And so the lows were generally in that 50 to 55 range, 2008, and then June of last summer when it looked like everything was coming off the rails and the Fed was doing 75 basis point hikes. They started their first one. So if you look at the bottom of the index, I put the history of there from 1963 to 2023 here. So you've got 60 years of history, and I put a red box around those lows. So if you look at when it dipped down in 1979, when Volcker took things prime of 21%, if you look back in 2007 to 11, when we had the great housing crisis and subprime mortgage crisis, and you look at today, what you'll see is the confidence dips down. And then there's some sort of intermediate intervention that brings it back up temporarily, and then it goes back down for a permanent second time. So we're seeing that same pattern right now. And the reason we're seeing it is last summer, the administration did tap the Strategic Petroleum Reserve to bring energy and gas prices down. That made everybody feel a little bit better. The other thing that's just recently happened is that after the Silicon Valley Bank and First Republic Bank failures, and we had this ominous debt ceiling crisis coming, we got past it. So consumers saying, okay, the end of the world didn't come, Y2K debt crisis didn't come. And so they felt a little relief here going into the summer. And so their confidence has said, let's just go on vacation. And when we come back, there's a lot of headwinds that we're looking at. We get the bank stress tests tomorrow. We have 10 Supreme Court rulings coming out by Friday that are of the most polarizing social issues that we have in the country. We have a new jobs report coming out early July that's going to be strong again and probably show more inflation. We have another Fed meeting at the end of July. We have a bank stress test that are really going to reveal a lot on the bank, and on those 23 banks that aren't stress tests, the FDIC and the Fed and the state bank commissioners are in looking at those banks over the summer. And they're scrutinizing commercial real estate a lot more. So as you know and have heard me, I think we've got potentially 200 to 300 bank failures right now. The banks that essentially are out of capital. If you look at their Texas ratio, they're above 10%. So the bank has 10% capital, and they're through that. So they're above that. So what is the Fed going to do come this fall when it's looking at that? Or in the first quarter, we had over 720 banks whose unrealized losses were greater than half of their capital. One more quarter like that, and we have potentially twice the number of bank failures, end of this year and the next year that we did in 2008 to 11, which was 485. So there's a lot of headwinds that can really knock this consumer confidence. So, look at the history. Right now I'm saying on data, go beneath the headline number, look at how it's composed, kind of like I just did on on the CPI, the subcategories, and then look at the trends. And things just don't go down and recover. A lot of times they're like a saw blade. And that's what we're seeing again here through our last three, the late 70s, the great housing crisis in 2007 to 11 and 12. And then again, right now, we're seeing that same pattern, comes down, comes back up for some reason like Strategic Petroleum Reserve, and then it comes back. All right, the next thing we need to worry about on these banks is what's happening to deposits. And so, as you know, if you had any money in a bank, you weren't paid more than 1 to 1.5%. Then Silicon Valley Bank happens, and everybody pulls their money out because they can get over 5% in a 30-day treasury, or in money markets, you can get 5.5%. Or the overnight SOFR rate is 5 to 5.5%, which was the old LIBOR equivalent. So why would you leave your money in the bank? So deposits left just to get a decent return. Why get 1.5 when you can get 4.5 to 5? So that left. The other thing that left was when we had Silicon Valley Bank and First Republic, the Treasury Secretary said she inferred that only large, systemically important banks, the top 23, had a backstop on deposits. So deposits said, wow, they're going to let the community banks fail. They got 4,100 of them. Let's get out of the community banks. The other thing that's happening is we're seeing that the banks have to reprice what's on their balance sheet. So their liabilities are the deposits, and their assets are what they've lent into or that they bought. So they bought a 2-year, 5-year, 10-year treasury. If they did commercial real estate, they bought mortgages that didn't get sold yet to the GSEs, the government-sponsored enterprises. They're sitting with these fixed rate instruments that have to be marked down. And so that process has not happened. And we don't know what's going to happen with all these commercial real estate construction loans in the bank, especially the 300 plus that are CRE concentrated. Many of the banks I'm working with, they don't know how to estimate their future funding. They don't know what developers are going to do with an apartment complex or an industrial development. They may just finish what they've got in progress, and they may stop because of the cost and the interest rates, and they can't get the capital, or they're going to try to power forward. The banks don't know what they're going to have to fund. And so they don't know what kind of deposits they're going to have to go out and get. So if they're having to get paid 4.5% for those deposits, but their business model on those loans that they made assumed like less than 1%, they're losing money on every construction loan. And so the banks pay attention to what happens in the earnings here, how much capital they're going to have to add. It's a broken model. So this is one to watch. We've had over $1 trillion in bank deposits leave basically from a year ago. And it's pretty substantial as we go forward each week after week here. So again, you can see there at the bottom, over 700 banks are facing significant safety and soundness issues. And that's almost double what we had that failed in the 2008 to 12 timeframe. So here's how many banks, if you ask this trivia question. So I think we're down to 4,125 after the First Republic and the Signature Bank failures, and that the U.S. banks hold over $7.7 trillion in uninsured deposits. That means there's $7.7 trillion. And think of that in size. The Fed's balance sheet's at about 9 trillion. So it's more than almost the same amount as the entire Fed's balance sheet. Have people that have deposits of more than 250,000. It's uninsured above that amount. It's crazy that is out there today when it doesn't need to take that risk. And when you look at who has the most amount of it, 43% of that $7.7 trillion in uninsured deposits is in JP Morgan, Chase, B of A, Wells Fargo, and Citi. That's incredible. And these are the largest, too big to fail type banks. So when these stress tests come out on Wednesday, there's a lot of nefarious stuff that I think is going to have gone on in those stress tests I'll share in a minute, that to protect these banks, because if we have another Silicon Valley social media rumor or First Republic, and you see capital suddenly want to pour out of, Citi or Wells Fargo or B of A, they could be just as much of a victim on a social media rumor, but they're holding a lot of uninsured deposits there. So this is a big concern. So here on slide 12, I put our top U.S. banks with uninsured deposits. This may surprise you. So you can see at the top, JP Morgan, Bank of America, Wells Fargo, Citi, U.S. Bank. But scroll down, look at number 7, Truist Bank, the 6th largest bank, headquartered in Charlotte, North Carolina, used to be SunTrust here in Atlanta. Scroll down, look at number 13. First Republic was the number 13. And you've got 12 entities that have more uninsured deposits than First Republic did. That's pretty doggone concerning. Scroll down further, look at some of the really good, regional banks that did a lot of CRE lending, Key Bank, Regions Bank. they all have massive amounts. They're almost in the top 25 in terms of uninsured deposits. And you can look at the numbers over there. So it is absolutely insane that the Fed has allowed this situation to develop. We combated this in 2008 and 9. It was taught in banking schools, going back to the first one, that banking school liquidity risk management 101 is understand this issue in your deposits and how quickly they can flee. And we really don't need to be there. So I mentioned this in Boston, don't know if it filtered out, but there's a program called CDARS, CDARS. It's for Certificates as a Deposit Account Registry System, and it's managed by the FDIC. What they do is they say, let's say because of payroll purposes, or you just like your banker at ABC Bank, in Colorado or Las Vegas, and you want to put $1 billion in them. Well, you can put $1 billion in one bank and it be fully insured. What you do is you tell the bank to put it in this CDARS program, which the FDIC then takes it in $250,000 increments and spreads it out among 3,000 banks. You have just one bank relationship. You get one statement. They deal with everything in the background. So why don't more people do it? Well, the bankers don't want you to do it, because if they have to take that $1 billion and only keep 250,000 and spread the other $975,000 out among other banks, they don't have those deposits. So that's less capital to lend. So the dirty little secret that the FDIC and the Federal Reserve have allowed to happen really since the great financial crisis is they've allowed banks to say to developers and brokers, we need more deposits from you. We need all of your deposits. Put all of them with us if you want a construction loan, if you want a real estate loan. And so we kind of blindly go along to get that loan, and we don't realize that we could tell them after we close that loan to put all of my deposits in CDARS and really tick them off, but have your money safe. So I encourage you to know about it. If you got brokerage, if you got payroll, there's a lot of reasons you may have over 250,000 in one bank. Don't be at risk. If Silicon Valley Bank had followed this, they might not have had as much capital to do venture capital lending, but we would have had zero hit the FDIC fund, zero. And so it's absolutely, to me, criminal that we are now having to debate how we're going to replenish the FDIC fund when this instrument was in place. So know about CDARS. It's your friend. All right. The next thing I want to talk about on slide 14 is after the Silicon Valley Bank failure, the Federal Reserve, I'll at least give them to their credit on this, they did a forensic analysis of what went wrong. And what went wrong was they didn't have a clue what they were doing in bank supervision. And they admitted, they said supervisors in the middle, the red arrow there, did not fully appreciate the extent of the vulnerabilities at SVB and as they grew in size and complexity. And when they did identify the risks, they didn't do a damn thing about it. And so this is absolutely awful after what we went through in 2008 and 9. And I was there at the Federal Reserve during that time. And we thought we implemented things to make sure this wouldn't happen again. But when I was at the Federal Reserve in Atlanta and New York in 2009, the Atlanta Fed came under scrutiny because of what was happening at then SunTrust Bank, now Truist Bank. And they came down and looked at their subprime mortgage situation, and they basically had to liquidate their Coke stock to recapitalize. And what they found was they were AWOL on bank supervision as much as the San Francisco Fed was on Silicon Valley Bank. And so you know what happened? The Federal Reserve took away supervisory authority from the Atlanta Fed for 1 year, and it put it in the Richmond Fed, and essentially cleaned house on bank supervision. The executives from the top all the way down got early retired or moved out of the system. And so we went through that in 2009. The same thing that just happened in San Francisco Fed and Silicon Valley Bank. The San Francisco Fed got too cozy with Silicon Valley Bank. They didn't do their job. They didn't enforce actions. And then we have this big blow up. And I think you're going to see the same thing happen. The Dallas Fed or maybe the Kansas City Fed takes over bank supervision from San Francisco to basically clean up the mess and get back to bank supervision. These are the Fed's own words. They're not mine saying we didn't know what we were doing, that we screwed up, and that we don't know what we're doing on bank supervision. And as depositors, as Americans, those of us that rely on this monetary system, to have the Fed admit this and this candor is really quite concerning. So this is why I'm so critical on the Fed. And these are their own words. They're not the Red Shoe economist words. All right, let's look at what's going on that we're going to get the results on tomorrow on slide 15. So TREP does a great job not only monitoring and analyzing the CMBS world, but they have a tremendous bank navigator tool that allows all those banks that are below the top 25 to do their own form of stress test and to do their own analysis. And it's called Bank Navigator. and they report on what's going on in the stress test. So earlier this year, they noted that the stress test mandate that we're going to see how these banks held up to was that they were to look at all their commercial real estate, not only in the line of business, but everywhere they got it squirreled away. And they had to say, what happens under a severe stress scenario where you lose 40% of the value in commercial real estate? And you need to hold 4.5% capital. So you've got 10.5, and you have 40% of an asset that you're 300% concentrated in. Do you still have 4.5% left over? Not unless you got the same CPI people doing their math and algebra and whatnot. So if we see clean results and everything going fine on these 23 banks, I'm sending a big jar of barbecue sauce to the Fed Stress Committee. There's no way that in this environment right now, with the amount of CRE concentration we have, that you can take a 40% hit to commercial real estate when you've got 200 to 300% of your capital in it and still have any kind of capital left over, at least half, 4.5 of your 10%. So I'm very suspicious of what we get tomorrow. And again, here's TREP. They do the best analysis on this on, those other 4,100 banks that, from the 4,125 to 2324 that are stress tests. So here on slide 16, these are the banks that are undergoing the stress test. These are the 23 that will get reported out. And a few things that I want you to understand is that a couple of things are going on with the stress test. The banks have been doing this for a while. So they kind of know, it's kind of like, if you're doing your taxes and you learn all the loopholes, you kind of know what to fudge and do in the stress test to make it turn out right. They've been learning and reporting to the tests, so they don't have the same meaning. The other thing is, you're seeing the red font there in the middle on the left, that we ended a couple of years ago the pass-fail mandate. We used to say to the banks, it's a clear pass or fail. And if you fail, you can't do stock buybacks, you can't increase your dividend, and you got to build back capital. And so that was real punitive, but the banks complained, and they complained to their Congress and senators. They complained to Trump that this was too onerous, and their stock would go down and investors would leave. So the Fed got pressured when they say they're not political. They are political. They stopped the pass-fail model. That was a big undermining of the credibility of these stress tests. So now it's, kind of a more nuanced thing in language, and nobody really fails. But we'll see what their capital is, how far it falls. So if it gets anywhere down, near that 4.5% level, which I think of these 23 banks and the amount of real estate they have, you look at a Wells Fargo, you look at some of these others, you look at, a Truist Financial that has a lot of commercial real estate and syndicated deals. They have a lot of big office deals in New York and Houston and California that aren't readily apparent. But I think they would fail these if we did the pass-fail model. So it'll be interesting to see what we get tomorrow. All right. Why this all matters, slide 17, is what we're seeing. We wouldn't even talked about this a year ago, even though it's been building for a while, is BRICS. It's an acronym that stands for Brazil, Russia, India, China, and South Africa. And now we're adding Saudi Arabia, Mexico, and Egypt. These countries have come together and said, we no longer want to be a dollar-denominated economy. We don't want oil. We don't want our commodities. We don't want to be able or be limited in trade by how many US dollars we hold. So if I'm in Vietnam or South Korea, I'm limited by what I can trade with America based on how many dollars their central bank holds. And they said, we're done with that. So we want to have our own digital currency. It's happening very, very quickly. It's part of the de-dollarization. And we now have 30 countries that are over 40% of the world's population and a quarter of the world's GDP that have said, see a dollar. We're going to have our own currency. We're going to trade among ourselves. Saudi Arabia said, yeah, United States, if you want to buy oil from us, you're going to have to pay us in BRICS currency. So this is really serious, and we need to be thinking about this from a commercial real estate, because we may find that foreign entities that want to invest in our real estate or transact with us, they may require us to understand BRICS. So just like we had to learn, about Bitcoin and digital currency, and we had more trade going on, we may find that there's a different currency world out there that affects us. So keep this on the radar. It's moving very, very quickly. All right. So I always have a good book recommendation. This came out the end of last year. I met the author, really sharp guy. He's not a banker. He's not an inside Wall Street guy. He was a really good journalist. And he tore apart the Federal Reserve. And he wrote this book that he published in the last year called The Lords of Easy Money, How the Federal Reserve Broke the American Economy. And he nailed it spot on. The only issue I have with the book is it's 300 pages of nothing but words. There's no pictures, there's no charts, there's no graphs. So I'm one of those people that when I went from kindergarten to first grade, I hated it because they got rid of all the picture books. So I've offered to help him rewrite it, and we'll make it 500 pages, but we'll put a lot of pictures and stuff to break it up. But if you read something at the beach over the summer or in the mountains this summer, I'll be in Colorado in July. It's an easy read. You can do it basically in 2 nights. This is spot on, and it'll give you some heartburn about really how badly our Federal Reserve and our monetary system is. And I'd remind you, I was at speaking a week ago down in Mobile, Alabama, and the branch executive for the New Orleans branch on the Atlanta Fed was speaking about the Fed and its history and all that kind of stuff. And she was talking about how the Fed was created as part of the Constitution, and it got its original mandates 200 years ago for full employment. She had no clue. This is our 3rd central bank. The first 2 were only allowed for 20 years. They had a schedule, and Andrew Jackson ran on ending the Federal Reserve, not renewing it, and he prevailed. So then we had the overnight camping trip by the elite wealthy bankers from New York to Jekyll Island, Georgia. Nothing good happens on a camping trip from New York bankers in coastal Georgia. So they hatched the idea of another central bank that they got passed in 2013. And some of I've mentioned, a trivia question is which state is the only one to have 2 district banks, and it's Missouri, in the Kansas City, Missouri side and the St. Louis side. And the reason that existed was in 1913, they were 2 votes short of the Federal Reserve Act passing. And the big issue was nobody trusted the evil New York central banks, the JP Morgans and Vanderbilts, and the rest of our country was still pretty much an agrarian economy. So it was a compromise to get those 2 votes. They said, we'll put 2 central banks in the same place in the Midwest, Kansas City, and both in Missouri. Kansas was still a territory at the time. And so they said, we'll put them there, and that'll mean that there's an equal amount of capital in the Kansas City and St. Louis Fed district banks as there is in the New York Central Bank. And that was supposed to be the great equalizer to make sure that the agrarian economy in the country had just as much of a footing as the New York banks. So this is a real good read. I strongly encourage you to read it. So let's shift to maybe some good news, unless you're in the West Coast or the Northeast. So slide 19, the Census Bureau, believe it or not, just updated the 2020 census and looked at where we all were moving in 2020 and 2021 after the census. And it's still consistent with what we knew in U-Haul moving reports and the 2020 census. Is the red areas are where we're moving away from, the Northeast and the West Coast, and the blue is where we're moving toward. And so you can see it's really a Southern and an Intermountain and Midwest kind of story. So whether you're from Boise or Idaho or, Montana, all the Californians are moving to Montana, running the cabin prices up, down to Salt Lake or, into Utah, throughout Utah, Arizona, Colorado, Nevada. That's in the Intermountain region. It's an affordability escape. Now they're creating the lack of affordability, and you got Texas in the South. So that story has not changed. And here's why that's important. If we're going to have 6, 7, 8% inflation for the next 2 years, you need to have population and workforce growth that matches that. It's the only way you can outrun it. So if you've got 6, 7% population, workforce, company migration into your state, you can weather 6, 7% inflation. So that's why that's important. And none of this is a change story, but it's just a refresher that I thought I'd share with you from the Census Bureau. All right, there was a piece that came out on Globe Street, a really good piece if you haven't read it, because it really looks at both sides of is CRE dead or is it long lived real estate. And so on slide 20, you can see the bullet points there. They chronicled all the prior, in my lifetime, I'm 60, born in 62, all of the major, catastrophes and collisions we've had in commercial real estate, and how we had losses, but we powered through and we came back and people made money. So whether it was the S&L crisis, the dot-com crash in 2000, the recession in 2001, the Great Recession 2007-12, we've always had wreckage in real estate. It rides up, something happens, we change tax laws, we overdo it, we overlend in it. And so the one part of this article says this is just another one of those cycles. And we'll have some carnage, but we'll power through. But what I want to remind folks in the left side there, according to the TREP folks that they provided on CNBC, is we have $1.5 trillion of commercial real estate that has to refinance in the next 18 months, basically between now and the end of 2024. And we have double that by the beginning of 2026. So that's a lot of real estate that has to refinance. The CMBS market is shut down by 80%. When I was at the Fed, it shut down by 100% in 2009. And I was involved in going over to the TREP folks to figure out how do we restart securitization. So this is a big number at a time when banks are being told, don't book any more commercial real estate loans. You have too much of it. You got to reprice it. We know cap rates are moving. So it's a real tough time that we're going to have to deal with. Where is the capital gap going to come from as banks in the CMBS market pull back? Will life companies, will private equity, credit unions, who's going to step in? And more of that will step in and cherry pick the stuff. So not everything's going to have an equal opportunity to capital. All right, so what does that mean for value? Slide 21, this is the updated Green Street. But as you know, this is the better stuff. This is the institutional quality that probably gets refinanced, reworked. RCA and CoStar have other similar CPPIs that are more the common generalized commercial real estate, the under 10 or $20 million stuff. But all of them are showing the same thing. If you look at how far values have come, they've come off, anywhere from 15 to 20%. The worst have been in office, and believe it or not, apartments, at 21%, office at 27%. You look at it's continuing, the trend is continuing down. Look at the past 12 months, look at the past month. We know all the stories, whether it's from Vornado or Brookfield or, PIMCO, or now the plethora of stories coming out of California, San Francisco on California Street, all the buildings that were sold 3-4 years ago, at 200-300 million that are being let go and foreclosed on at 25 to 50 cents on the dollar. We all understand that. So this is kind of what's going on there. So let's look at we got a big correction coming. So you're gonna have to be dealing with clients that are, remember, the Urban Land Institute's primary theme from their 2023 Emerging Trends Report is that buyers and sellers can't agree on price. Sellers still think that we're a year and a half ago before Fed rate hikes and the cap rates are 4 to 5. And buyers are saying, are you crazy? Have you been in Colorado doing cannabis edibles? You need to come back to the rest of the world and know that we're really at 6 to 8% cap rates, with an exception. So many of you might have read about this the last 2 days. This is the big industrial deal that Prologis did with Blackstone. And here's what's mind-boggling. So the REIT that I was on, Monmouth, that sold February of 2022, we sold at a record 4% cap rate. It was like perfect timing at the top of the market before rate hikes. Everybody loved industrial. Nothing was wrong in the economy. And this deal just sold at that same level, 4% cap rate, 70 buildings, $3.1 billion at a price. Imagine this warehouse is at over $220 a square foot. So is this indicative of all industrial? Is this what we can say we can brush everything off? And if you've got industrial listings, that you too can expect a 4 cap rate, $200 plus square foot rate? And the answer is no. So here's what happens. We need to understand the motivation in transactions. So Blackstone had to sell this portfolio. They like industrial. They want to buy more of it. They have a little problem called redemptions, and they need to sell their best stuff to raise enough capital to meet the redemptions out of their funds. And so they picked this best stuff. This started being marketed to Prologis and others before Silicon Valley Bank, and it accelerated after that. And Prologis has got this huge surge of cash coming in from it. It's the largest industrial REIT in the world. It has all this cash flow coming in, and it needs to put it to work. It's not going to put it in a bank. It's not going to, go buy 30-day treasuries at 5%. It needs a lot more than that in terms of the return it's got to pay on its REIT. So they're wanting to buy tangible hard assets. So they stepped up and said, we think this 4 cap rate will grow into a 5.5 cap rate in 2 years. So my response is, great. Let's say it does get to a 5.5 cap rate, but we don't tame things and the Fed stays higher for longer. How do you make any money, even at a 5.5 cap rate? So we got to understand some capital has just got to go to work. And other capital has other motivations, like they got to meet redemptions, so they're going to sell. And so this is not indicative of all industrial assets, but we may see a couple more portfolios, but it's going to be a very limited audience. And the more basic stuff that you have in your market, that's a building or 2 buildings, they're not going to trade at these prices. They're looking at more 5.5 to 6+ cap rates and nothing near $220 a square foot. All right, so here's another piece that came out on CRE values. I thought this one was interesting by CRE analysts. They're a good group. And they looked at what's happened to equity. And what they've seen happen is they think 40 to 50% of all equity in commercial real estate has been wiped out over the last year. So if you're a banker, what that means is you're over 100% loan to value. That's the reality of what banks have to look at when the examiners come in and they say, you got to reprice this stuff and you got to get it revalued and you got to reshore up your equity, or you got to raise deposits. You got to put these on criticized loans and you have to raise capital to add to your loan loss reserve allowances. And so this is pretty scary to see in this quicker time. I've never seen at this pace this amount of equity being lost out, $2 trillion of lost equity before we even get into the debt side. All right, let's talk about housing. I know we all do commercial, but we need to understand what's going on with housing because commercial real estate follows rooftops. And if we ever didn't learn a lesson from 2008 and 9, it was that we built all these subdivisions, all these houses, and nobody was moving into them. So all the shopping centers and office assets and commercial assets that were built anticipating people occupying those subdivisions, they hit the wall because there was no one in there. So let's look at what's going on in housing. So here's some good news, bad news things. So the bad news is your home isn't appreciating as much as it was a year ago this time. It was going up 16% a year. Right now, it's only up 1.6%. Here's the good news. At least it's still going up in value. This isn't 2008 or 9. Your home's not going to go down in value. You're just not going to see as much appreciation because the debt service cost to put a new mortgage in place when you could get sub 4 and now it's like close to 7%. That puts a lot of people out of the market. The highest year over year home price appreciation, if you look at by geography in the country, all right, all you in Midwest, stand up and take a bow. It's in the Midwest. Places like Milwaukee, Kansas City are up there with Miami. Those are the top 3 places that are seeing the highest home price appreciation. Miami is an international play as well as a migration out of the Northeast. And in Kansas City and Milwaukee, this is workforce leaving the West Coast and the Northeast looking for affordability. And this is where companies are relocating, or if you're in remote work, you can get to a great airport. So if you're in Milwaukee, you can get down to Chicago pretty easy. If you're in Kansas City, you got a brand new airport that works really, really well. So you've got the mobility. So take a bow, Midwest, you're finally getting some needed respect. The cooling MSAs where the home price appreciation is cooled the most, it's really all in the West and Southwest. It's San Francisco. We've all read about the problems there. And believe it or not, places like Phoenix, part of Phoenix is the water issue. You can't get any more building permits issued in Phoenix or Arizona. The Hughes Corporation got shut down earlier this year from 100,000 unit development in the West Valley. And most recently, they finalized the reduction agreement between the 7 Colorado River states that says everybody's got to reduce their consumption by 13%. That's better than the 30 they've been talking about. But what it means is they're going to reprice what water costs. That 13% water that you're going to take, it's not going to be priced at $20 an acre foot. It's going to be priced at $520 an acre foot. And that's what the government will pay you not to grow crops, not to issue building permits. And so when you look at what was feasible to do, and whether it was residential development or agricultural development in the Southwest, and what the costs are, especially if you're in the lower basin states like Nevada and Arizona and New Mexico, it's almost not feasible to do anything. And I'll share an example of that with you right now. So here it is. This is a deal. So for past 75 years, water's been priced coming out of the Colorado River at $20 an acre foot. It's now going to go to 25 times that. So think about an input. If you've got taxes or insurance, and it's a big item, and it goes from a little bitty thing to 25 times what it was, it can take out the entire margin. So if you get down to the bottom there and you look at what a farmer growing alfalfa in California, where when he could buy the water at $20 an acre foot, now he's got to pay $521 an acre foot. He loses money for growing alfalfa. So there are going to be a lot of uses. There's going to be a lot of change in land values if you can't get the water, or you can just be paid not to use the water. And so this is getting to be very, very serious, particularly the lower Colorado River Basin states. But anyway, Colorado, New Mexico, Wyoming, Utah, but particularly, Nevada, Arizona, New Mexico, the lower river basin states where they can't pump out of the aquifers anymore, and there's no more coming down the Colorado River. This is going to be a very serious story. So for those of you in the Colorado River Basin states, so 7 states, you really need to be paying attention. What I talked about a year ago that was coming down, quote, the pipeline, it's really happened in a big way. But just think of that. Water that used to be priced at $20 an acre foot is now over $500 an acre foot. That's changes the highest and best use or feasibility in what you do with land and the water that you need to do it. So think about multifamily development and how much water, and this is going to change the nature when you're buying a multifamily deal or a commercial real estate asset. You're going to need to look very seriously at what kind of water saving mitigation, because you can't afford to pay $521 an acre foot and have someone take a 30-minute shower in your apartment complex. Just can't do it. All right, so let's look at, what's happening in multifamily, and this ties right into the water expense. So look at what's going up even more than on the water side. It's property insurance, but maintenance as well. So this is just was just out produced. Globe Street did an article on this covering some of the data and reports that were just released. And so what we're seeing is rents last year. If you looked at everything put in the bucket, we didn't even have 1% rent growth, and year over year. But look what's happening in property insurance. Many of you have clients or you may have investments, and you're seeing that 50% would probably be a nice number in Florida. They're seeing like 300 and 400% increase in property insurance. Look at what's happening on maintenance expense. Part of it's the labor, part of it's getting the material. So if you have an HVAC that goes out, or an elevator, a lot of times you can't get the parts. You're going to pay double for the parts, and then the labor has gone up 20 or 30%. So maintenance expenses are up 28%. So when you look at things like water, you look at property insurance, you look at maintenance, and you look at what's happening, forget the days of 30 to 35 expense ratios in multifamily. It's 40% plus. And so if you're only growing rents at 1% and you got 25 to 30% more in expense ratio hitting the property, your NOI goes down. And even at the same cap rate, you're looking at 15 to 20% declines in value. So multifamily isn't escaping, and I haven't seen any 4% cap rate deals done in multifamily like the Prologis industrial deal. So this is going to be the big story. Property management is going to be the focus. How do you use property management to help you work on and contain the expense side of your property ownership? And so it's going to be less on what you can do on the rent growth. That's going to be limited by the market, but the expense side you can control. And so how do you do that? What are the innovative ideas that you come up with? And one of them I see increasingly here in Atlanta is that in apartment complexes, they're no longer allowing free electric vehicle recharging in the parking garages. It's now $300 a month. So if you got an EV and you need to recharge every night, they're adding a flat fee of $300 a month on your EV charging. So you're going to see tenants finding that even though the rent didn't grow, there's expenses that are being added on. There's new common area maintenance, utility expenses like we had in office buildings that are being layered into new leases. And same with EV charging. So here's though what I think is the biggest headwind that we face in housing and retail is our household debt. So the Federal Reserve, the New York Fed, produces a household debt report every month. And the newest one that just came out for May showed that we hit a record 17 trillion in household debt. And so I put some arrows, kind of tan, orange, and green arrows for credit card and auto loan debt. And so look at the green in the chart there, how it's moving up, and look at the orange, which is credit card debt. These are growing off the charts. We now have almost $1 trillion in credit card debt. We have 17 trillion overall. Look at the auto. And so we're seeing more consumers. If you look at the earnings reports from Auto Nation or Carvana or whatnot, they're having a hard time finding used cars. The new car inventory is so expensive. You're looking at the median price of a new car now over 50,000. A truck, it's over 70. So people are trying to switch to used, which are getting closer to a new car, and they might have 50 to 70,000 miles on it. So that's not good. But this household debt picture, and now you look at that the interest rates have doubled. Most of this is either variable, or you look at the credit card debt, you've gone from 8 to 10% on your credit card to now it's probably more like 12 to 18%. And so you look at a higher interest carry cost, you look at having to put more of your daily stuff on the credit card to make it. You'll see in a minute, I'll share that 1 in 5 households now buy their groceries at a dollar store, or they've got facilities that help them do that because they can't afford to do it with cash or their bank debit card. So this is the biggest headwind. It's not just the dollar amount. We're putting more necessities than discretionary on the credit card, and the interest rates are double what they were a year ago. So office, I'm not going to beat it with a dead horse. The suburban, I think, is still doing good. If you've got 3 to 5 story stuff, multi-tenant, near where a lot of your employees live, companies are scrambling to figure out how to lease smaller chunks of suburban office space so their workforce can work remote, go in and have team meetings or be in with client meetings, 1-2 afternoons a week. But none of them want to go commute in big urban cities, New York, Chicago, San Francisco, even Atlanta. I got many colleagues that don't go in, but maybe one day a week. And we're seeing one of the most popular adaptive reuse is taking a branch bank and converting it to remote office. So pretty big, but look at these numbers, in New York alone, an estimated 28% decline in the values, over 500 billion in value destruction. And I've got up at the top there, note Atlanta office for Seattle. So one of the other barbecue sauce statements I heard from the New Orleans branch executive of the Atlanta Fed, they said, in the Atlanta Fed, we don't have San Francisco office problems. We don't have New York office problems. All our offices are fine. So I did a little digging, and roughly Atlanta has 800 office buildings of 50,000 square feet or more. So I dug a little bit deeper and worked with some of you and our brokerage clients and found that 20% of those 800 office buildings have less than 50% occupancy. They're over 50,000 square feet. We have a severe problem. We've got office buildings in the suburbs, in the downtown area, that have either gone through workout or foreclosure or in the process of it now. So if you think just because you're not Seattle, San Francisco, New York, Chicago, that you don't have an urban office problem, you are probably mistaken. And the same trends that occurred there in remote work and affordability and everything else, whether it's Nashville, whether it's Atlanta, Orlando, we all have this same similar problem on urban office. And this piece was really good. That it's worse than first thought. And the people that did the report on this, one of the PhDs was formerly at NYU, Stin, I can never pronounce his last name, Newberg, but they've just re-updated it. And they said it's double what they thought the numbers were. So these are very credible people that taught the real estate programs at NYU. They know what they're doing. These aren't just academics that know what CRE stands for. All right, so what's working in retail? Let's pivot a little bit there. So anything with a grocery store attached to it is working in retail. So if you've got retail and you're having trouble getting it financed or sold, give us a call or network, pension funds, life companies, credit unions. If you're one of the top 3 grocers in the market, that there's capital that will do that, as long as you don't have like 800,000 square feet of shop space in a regional mall. But grocery is working, small concepts are working. The other is dollar stores. So again, here, 1 in 5 Americans are buying their groceries out. That ought to tell you something about the economy. We're seeing these dollar stores now become half of their floor space is refrigerated. So they're selling milk and vegetables and things you would think of more in a grocery store. But these things are getting them closer to the consumer, closer to the more outlying residential and apartment communities. So dollar is working very good. It's relatively easy to do. It's simple construction. If you have a hard time getting it done, give me or my business partner, Beverly Keith. We've helped a lot of Dollar Trees that were Dollar General stores that were getting pushed back by local government because they didn't like the yellow color or they thought there were too many of them and they didn't understand the leakage. And so we used Site to Do Business to help them understand how much revenue and people were leaving their city or county to cross city or county lines to go use another Dollar Tree or Dollar General store. So they actually were losing revenue. When we showed them that the power of that in Site to Do Business, they approved the dollar stores. All right, what's not working in retail? This is the biggest headwind, and it's going to affect us in rents and absorption. So it's the shrinkage. I hate shrinkage. Why don't we just call it thievery? We can't do that as much politically correct, but they call it shrink, and it was a big deal at the ICSC and whatnot. And we're seeing it more pervasive in the earnings report, whether it's from Target or others, Walmart, that are saying this is a big deal. And this picture shows all the way that things have to be locked up and protected. So now think about the additional workforce you need in a retail store to leave the register or be available to go unlock things and escort you to the front register for checkout. Think of the cost of this technology and these devices. All of this is, think about the furnishings and fixtures and FF&E and the hotel or whatnot, that's all going up. That means the average daily rate. So the rent's going to be going up. Rents in retail are going to be repriced. And, we have to be very careful because a lot of retailers want to know what's happening with the crime statistics. And like me as an appraiser, I can't talk about that. I can't put that because then I'm being biased in some way. So there's going to be ways that this filters in and it's going to affect the rent equation. That retailers are going to pay less for the real estate because they need to pay for more of the technology and devices and the labor to deal with shrinkage and theft. So I'll give you my last word on commercial real estate. This is a really good report by MSCI, a good friend of mine, Jim Costello. They just put this out. And they said, look at the amount of troubled CRE assets are growing. It jumped by 10% in the first quarter. So what we've been waiting on for this stuff to come into the banks or come in the market, it's starting. It grew by 64 billion. So they're going to need a lot of CCIMs with a skill set. The audience is going to be less the bank. It's going to be more private equity. It's going to be more, the Blackstones or the Prologis that's trying to buy it. It's going to be the life companies. And then the other one is look at what's happening on CRE mortgage delinquencies. They rose by 3% in the first 3 months of 2020. That's a big number. 3% seems small, but in that time frame, that's a big number. So we've got a lot more of this stuff that's coming on the correction on CRE. So we are there, Gina. So we can see if there's any questions. If you're watching those, I hadn't been watching them, but we can see if there's any questions you want to select.
Yes, we do. Thank you, Casey. How much lag time do you expect before new construction pricing really starts to significantly improve?
So it's improving a little bit. It's gone from like high teens to maybe 10%. So the merchant developers I'm talking about, they're rebidding every 60 to 90 days. And some of the labor is coming down as projects are being stalled and labor is looking to replace, hey, this big deal I thought I had, the subdivision isn't happening. Maybe I'll check to see what's going on over in the industrial space. So we've seen it improve from the high teens to 8 to 10% range, but I don't think it's going below that for quite a while because we still have supply chain constraint. We still have labor shortages on that side. So I think it's going to be a while. I think it could be a couple of years, but I think if you're budgeting in that high single digits range and it still works, that's what you should expect. But don't expect us going back to 2, 3, 4%. It's like the Fed thinking we're going back to 2% inflation. Not happening for a while.
Thank you, Casey. AI has been major topic this year. The audience is curious about your thoughts on how this will impact CRE recovery.
So it's going to be one of those things our industry turns to get efficiencies. We're going to use it to wring out labor. There's a lot of things in the administration of real estate, the back office, the accounting. Think of the underwriting. Most of the underwriting can all be done through AI models. You can almost have a call AI GPT chat and ask them to put you together an underwriting package and tell them the metrics, and it'll all be produced to you just like a term paper. So those of us that do analytics, that do due diligence, that do underwriting, that do accounting, some aspects of property management, we're going to bring out 25 to 40 or 50% of the labor. That AI is going to be able to replace that. But here's what we're missing. So someone's got to referee that output. So this thing, say like Wikipedia. Wikipedia can put a lot of stuff out, and I'll guarantee you 25% of what's in Wikipedia is barbecue sauce or it's out of context. And so how are we going to check that? How are we going to referee that? So really for CCIMs, we're the people that are kind of the referees. We're the real analysts that understand. I joke a lot of times, I can't do an Argus cash flow anymore. It's gotten so complicated, and I don't do enough of them that I would deem myself as not competent to do a complex Argus cash flow. But I can have a smart young person do one, and I can look at it and in about 3 minutes tell you 4 major flaws that they need to go back and look at. For example, if it's a stable asset and the reversion value is now 40 or 50% of the total value, that's wrong. Something's out of whack. The reversion value shouldn't get that high in a stable asset. It's maybe a value add. And a lot of times what I find is that they're growing the rent number on a quarterly basis and expenses on an annual. So rents are going up quicker than the expenses. So I can look at something, the analytical skills. And that's what CCIMs are great at. And our curriculum is great at, is teaching us those kind of common sense acid test ratios to see if something's barbecue sauce. So who's going to be the referee? Who's going to be the analyst? But we're going to see great disruption. I think on my appraisal side, I think the commercial side can go and maybe even be better, than the Zillow side and what we get, because the typical appraiser MAI is now in their 60s plus. They're lazy or they don't want to do things. And so the values are largely off. I do a lot of expert witness and shred those. So I think appraisal, property management, administration, underwriting, we're going to see a lot of labor force reduction, and that AI is able to do that quicker and better without people.
Do you expect banks to postpone appraisals in order to avoid dealing with the repercussions?
They're doing it right now. In fact, I'm dealing with kind of the friction between the regulators and some banks. So banks are allowed, they don't always have to get a new appraisal, It's not like Freddie and Fannie or some of the CMBS with special servicer rules. So they just have to be able to support the new values. They can do what's called an internal evaluation. So they can go in and take the old appraisal, they can update the leases and the NOI and expenses, and then they can kind of make up their own cap rate and say what the value is. And so the regulators know they've lost confidence in a lot of the valuation work out there. They know that all the appraiser is going to do is put, a 7 or 8 cap rate instead of the 5 cap rate he did last time. They're not going to really refresh things. I wrote a piece after 2011 on what do appraisals really measure. And what we found was the reappraisals were so bad. It's so atrocious because appraisers didn't go back and do the homework on the market or what had changed in leases and renewals. And so the regulators are more accommodating to the banks to let them do an internal evaluation. They just have to support and provide to the regulator that they did something to refresh the value. So I already see the banks pushing back. They don't have the cost to dump into these appraisals, and they don't believe the value add is there. So they're looking for alternative tools.
Excellent. Well, it is getting to be the top of the hour here. Casey, thank you again for sharing your expertise with us today on this webinar. We're happy to share this webinar with members only today, and this is just one of the many member benefits that are designed to help you adapt and thrive in 2023 and beyond.